This video is rated for mature audiences only. If you're a communist, a special snowflake, introduce yourself with "my pronouns are," put sugar in your coffee, and still drink vodka orange, please go. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the weekly heat map of the S&P 500. Very interesting day of trade, very mixed across everywhere. We look at something like semiconductors. Everything excluding Nvidia was actually fairly green. That was on the back of TSMC news and a couple of earnings reports we got at the start of this week. Nvidia got sold along with most of the mega caps, Apple, Google. Meta was up 6% because of its earnings. So too was Eli Lilly. Software actually very upbeat, but this heat map doesn't tell us the full story of what actually happened this week. And looking at a sector analysis chart, this is the last 5 days of trade, and these yellow bars right here are cyclical sectors. The green is growth, and then this brown right here, this is just defensive sectors. Very clear to see the trade we had this week. It was cyclicals and growth over everything else, and this is exactly what we wanted to see in a recovery bounce. We wanted to see the defensive sectors get sold and cyclicals and growth get bought, especially because these guys last week led the selling to the downside. We also saw some very constructive price action. We actually rallied into the middle of the week, then pared some of those losses, but formed a higher low in comparison to where we opened on Monday, and then this higher low took us to weekly highs in some sectors. Not all sectors, but in some sectors. We could see that the best performing sectors this week was XLI, XLE, XLF. They were the worst performing sectors last week, so a bit of a recovery this week, and then XLC, XLK also in the positive. Now that did lead the SPY to finish flat on the week because we had stuff like discretionary materials, staples, real estate. They were all negative for the week here, and so the SPY was actually flat. The best performing index was actually the Nasdaq 100, up 0.39%. Everything else actually lost. The SPY was flat, the RSP was flat, the RTY was down 1.5%, and then bonds were actually down 2% for the week. This is the TLT in the context of them being at 1 point, up 2% for the week. A violent move to the downside in bonds. That meant yields actually rose, and this is just the market brushing off economic fears. They show that in yields and bonds, and that's the price action we saw, and that's why the mega caps outperformed and the Russell underperformed, because the Russell needs rates to fall to do really well. When rates are rising, that is going to affect the Russell more on the margin front than it is going to affect these stocks. These stocks do better when the economy is doing good. The Russell does better just when rates are easier, because they're faster growing companies, often uncorrelated to the global economy. And that's the price action we saw in the week today. A very interesting week of trade. Markets right now are at an inflection point. And I say this because what we saw in the S&P 500 here on Friday was actually a ton of volatility compression. You can see that the put support actually moved up to the 5,300 area. The core resistance stayed at 5,400, and the gamma flip moved ever so slightly higher. Very compressed range right here, coupled with the VIX falling 14% and almost 70% from its highs earlier this week. This is the inflection point. Whichever side we break, to the upside or the downside, we're going to see a huge move in that direction. So when we get volatility compression, that often leads to explosive moves in the stock market. But we could see very constructive price action here for the bull case. Very constructive price action. We had a massive sell-off. The peak to trough drawdown was about 9.7%, so just shy of a correction. We could pretty much call it a correction, but then we did put in a low right here, a higher low, higher low, higher low, higher low again, and in the context of running all the way up, making higher highs, retaking the gamma flip on certain days. Yes, it does move around, but we did retake it here on Thursday, here on Friday, and actually closing the week at the close of last week, making the S&P 500 pretty much flat for the week. And now it's either we're going to continue this move up, and what we need to see this week in the S&P 500 is a retake of this level right here. There's a lot of supply right here. If we go ahead, retake that supply, find support, probably means we do go onward and upward to the 5,500 area. But if we don't retake this supply level, let's say we go up, use it as resistance, that probably means we're going to trade in this range for the week. So we had a very key inflection point. I think if you're a bull, had you bought here, and I was buying heavily in this area right here, I was very vocal on it in my channel. I was buying heavily here. Had you bought here at the start of the week, you're probably sitting pretty on some very decent gains. You know, on a peak to trough weekly basis, you're up 4% already. That is quite the rally. And then from where we closed here on Friday back to all-time highs is just a mere 6%. So the market doing the right things for constructive price action. But this is where bears are going to get insanely active. Bears had the opportunity to take us lower here. They could not, which means they're going to get active in this zone right here. The bulls need to retake this, look to higher prices. The bears need to sell and take us lower from here. This is going to be a very key level in the S&P 500. But for everything we've seen in the S&P 500, when you bring it back to the longer term picture and look at something like the weekly chart, you can see that the S&P 500 looks extremely constructive. Assuming we continue the bullish momentum this week, this just looks like a higher low relative to this low right here. And then it's just onward and upward. And honestly, the next target would literally just be all-time highs on the weekly chart. And then this low just looks like healthy market momentum, a healthy pullback, all things considered. But all-time highs is still a while away, and there's a lot of hurdles right here, like we discussed on the daily chart, that the S&P 500 has to get through. So things looking constructive on the weekly chart as well as the daily chart. I don't see any reason to get really worried. At the moment, you just got to buy the dips. As long as growth remains robust heading into a cutting cycle, that's really good for equities. Equities tend to do really, really well. Earnings tend to grow, and we actually see broad participation in stocks. Think of 2020, 2021, when we had that insane run we had, right? What happened? Earnings grew a lot, and we were in a cutting cycle, a vicious cutting cycle. Now, there was COVID, I get it, I understand. But when you cut, earnings are growing and growth is robust, stocks rally. Now, I'm not saying we're going to have another 2021 everything rally. I'm just saying that when we get rate cuts in the context of economic growth, stocks do very well in an environment like that because margins expand, earnings increase, easier monetary policy, capital is cheap, and risk assets do really, really well. And that's why when you get these 10% market corrections, you want to buy the dip, you want to have conviction because nothing fundamentally has changed. And only when the fundamentals change, that's when we'll take a different stance. That simply isn't the case right now. Before this week, the levels I'm watching are right here, 5350, 5400, and if we do get above it, we can look to the 5500 area. Very clear-cut, concise levels, psychological levels. Don't overcomplicate your trading. Don't overcomplicate your analysis. Just hit the subscribe button, and I got you covered. And with the recent price action we saw in markets over the last week, retail was caught holding the bag. This is cumulative imbalances throughout the day, retail, non-retail. Essentially, what were retail doing? What was smart money doing? And you can see here that on Monday, retail was selling, smart money was buying. And that's why you go figure the price action throughout this week. Retail caught holding the bag, smart money always ahead of the curve. And the truth of the matter is we now know that a lot of the price action we saw in the S&P 500 wasn't fundamental based. It was mostly just based off the technical and major liquidation from the yen carry trade. In fact, the earnings picture remained relatively robust. If we actually look at S&P 500 earnings, we saw an uptick in guidance and earnings. Earnings went from 12.9% at the start of this week to 13.1% in the S&P 500. The guidance revision ratio actually increased as well, and that's why this opportunity right here was a huge opportunity for you to get long on perceived market risk that was never really there. And looking out beyond 2024, we can see that 2025 guidance is actually increasing on the up and up. 2024 guidance right here tracking well above the historical average and in line with the historical average X recessionary years, telling us that the fundamental picture is sound for 2024, 2025, and the price action we're seeing right now is just an opportunity to get long and buy the dip. And while we did have recessionary fears looming over the last week, if we actually dive into the data, references to economic downturns in earnings call are the lowest since 2021. And while you might look at the data and say, This normally means an uptick. What it does tell us is that economic conditions are very, very satisfactory. Had you think an uptick was coming right here or right here, you would have missed 1, 2, 3, 4 entire quarters of gains and rally in 2021. Don't get us wrong, guys. We only really started to pull back in the second quarter of 2022. We bottomed in the third end of the fourth quarter 2022, and that's when the 2023 rally ensued. It was sort of here towards the end of the second quarter 2022, start of 2023. So by the dip, things are looking really, really healthy. If anything, we have another 12 months of a bullish price action left in the S&P 500. And looking at the macro, this is the Fed's GDP now for the third quarter, their tracking estimate. Now, it doesn't look like it, but there's actually another data point in here. GDP is pretty much flat at 2.9%. Very, very interesting. Everybody thought we were going to go into a recession. A recession is defined as 2 quarters of negative GDP growth. We are not seeing that right now. In fact, growth looks rather robust. However, recession probabilities did tick up to 30%. This is the Bloomberg implied consensus. Market probability is 41%. The Goldman Sachs forecast is 25%. I think the truth is somewhere in the middle. Let's call it 30%. I think that is probably the probability of a recession, but we would need to see significantly weaker data in growth and employment. And while we did get that in NFP, that is simply not the case in something like tax receipts, tracking at 5% into August. Now, I know we're probably only about 1/3 into August, but tracking at 5% is very, very healthy. You can actually see this entire year, tax receipts have tracked 4.2%, 5.6%, 8.1%. This is the year-over-year growth rate. By the way, just for reference, anything above 3% for tax receipt growth is really, really robust. This is highly, highly correlated to GDP growth. So to see these figures right here, insanely good. And on the topic of the labor market, despite the weaker NFP we got last week, all employees, manufacturing jobs, residential building and construction, as well as goods producing jobs, continue to move to the upside, despite what we saw with the NFP print. While Hurricane Beryl, at least according to Goldman, didn't contribute to the rise in temporary layoffs, auto plant retooling shutdowns might have contributed significantly, as you can see in this data set right here. And at the end of the day, the rise in the NFP, the rise in the unemployment, which went from 4.1% to 4.3%, wasn't driven by job losses, rather just an increase in the population. You can see that the HH survey of unemployment decomposition actually increased with regards to last week's non-farms, and construction employment is at all-time highs. The unemployment rate increase isn't as a result of job losses, but rather an increase in the overall population. And the rise in temporary layoffs accounted for 70% of the increase in unemployment rate. Temporary layoffs are very noisy and somewhat less cyclical than permanent layoffs. So you do have to take last week's NFP data with a grain of salt when you look at all of the data I just showed you and put it into context. And you really have to look at stuff like initial jobless claims, continuing claims, and other payroll markers to determine what the economy might look like for the rest of this quarter, for the rest of the year. And by all of this data, things look healthy on the employment and the macro front. And we have another fairly big week of earnings, some notable stocks in notable sectors, but nothing major in terms of market cap. I mean, the biggest players reporting earnings are probably stuff like Alibaba, Applied Materials, Cisco, Home Depot. That's really it. We do have a couple of these smaller names in the North American space, stuff like NU, DLoco, Stone. We have JD.com, Walmart 2, John Deere. So still a very important week of earnings that can really move the market. But what's really going to move the market next week is economic data. On Tuesday, we have the inflation reports. We get PPI first, core and year over year, PPI inflation figure, the producers index. Then we get CPI year on Wednesday. And the reason why this is so important is because if we get weaker data, increasing inflation, That's just stagflation fears. We don't want stagflation fears where it's higher inflation, lower growth. Stocks don't do well in that type of environment. So we want to see the consensus figures here for CPI of 0.2 and then CPI year over year of 3%. That's what we want to see. If we actually miss on these figures, it's going to be very, very ugly for the market. And that's happening Tuesday, Wednesday. Then Thursday, we get stuff like initial jobless claims, US retail sales. That's a crazy week of data we have here. And then Friday, we have the consumer sentiment figures, housing starts, building permits, and then that's the week of data. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.